Welcome to this month's Economic Update. I'm Sinead, Rafferty, Portfolio Specialist at NAB Asset Management, and I'm joined by our Senior Economist, Bob Cunneen. Welcome, Bob.
Thanks, Sinead.
Bob, we saw the Reserve Bank keep interest rates on hold in July, which now marks the 2-year anniversary of no change to interest rates. What would it take for the Reserve Bank to make a change?
Well, the Reserve Bank's held this cash rate at 1.5% for a long time, as you note, of the view that keeping interest rates low will support the Australian economy in terms of employment, economic growth, and will progressively raise inflation. And there are signs that the Australian economy is moving in that right direction with stronger growth and inflation pressures picking up. But the Reserve Bank hasn't met its target in terms of inflation. So from their perspective, they need to keep interest rates low. So it's likely to be maintained. So we're looking at 2019 at best for the first stage where the Reserve Bank would contemplate raising interest rates.
Now, what we did see in July was quite a solid performance for global markets, particularly the US, which was up over 3.5%. Did that surprise you, given the trade tensions?
It does surprise us in the sense that trade is a long-term negative for both the American economy as well as the global economy, because it damages economic activity and it lowers employment and raises inflation because tariffs raise import prices. From the perspective of the American economy at the moment, what's driving Wall Street is basically a strong corporate profit story. So what we're seeing is corporate profits growing plus 20% over the past year in terms of the June quarter. We're also seeing very solid economic activity in the United States. So unemployment is down below 4%, economic growth is above 4% on an annualised basis. So these are very positive numbers, and for now they support Wall Street.
So Bob, how has the Chinese equity market performed over the month of July?
Well, the Chinese share market was down -3% in terms of the MSCI China index. So the Chinese share market at the moment is struggling. Now there are two key issues with the Chinese share market. Firstly, the trade war. So China has a key export market in America that is causing some trade tension by raising tariffs on Chinese imports. And the second aspect is the Chinese economy. So there's signs of a slowdown in the Chinese economy in terms of industrial production and retail spending. We've also getting signs that the tightening in financial conditions that we've seen over the past year, so trying to restrain credit growth in China, has impacted Chinese economic activity and corporate profits. So from that point of view, the Chinese share market is worrying about the global risks with trade. It's also worrying about the Chinese economy.
Is it fair to say that the trade tensions is implicating what the government in China can actually do to reduce this debt burden?
The Chinese government faces a dilemma at the moment. It needs to support the economy in terms of activity by providing easy credit, but the risk by doing so is that it extends the credit problems in China with the build-up in debt. So it's a bit of a dilemma between supporting growth and China's long-term financial stability. And it's a very precarious path that the Chinese government faces.
Finally, Bob, how has the Australian share market performed?
Well, the Australian share market in July delivered a mild positive return of 1.3%. Some of the sectors did obviously better. Telecommunications rebounded after some weakness earlier in this year, so they were up 7.9% for the sector itself. We also saw very strong industrial performance, up 3%. Against that, information technology and utility sector slightly disappointed, down about 1%. But all things considered, the Australian share market's doing reasonably well.
Thanks for your time, Bob. And thank you for joining us. If you'd like further information, it's available on the website where you launched this video.